Okay, we appreciate everyone coming in. Just before we begin the webinar, if you can hear me, if you could please touch that little yellow hand button, and we will watch for that, and that will just let us know that everyone can hear us.
Go.
Okay. All right, it looks like most people can hear us. So I just want to kind of introduce us a little bit. We are CETA Brokerage. We've been in business a little over 30 years now. We are a customs house broker, but we strictly work with duty drawback and classification issues. We do want to thank everyone for attending the webinar today. This is actually approved for 1 CES credit. So after the webinar, if you could email us all of your contact information as well as your NEI number, we will be able to submit that, and then you'll get credit for it. Also, when you signed up for this, you were sent a one-page questionnaire. If you would just mind taking some time to fill that out and get it back to us, we'd appreciate that as well. At the very end of the webinar, we're going to have a Q&A session. So throughout the webinar, if you have any questions, please type it in that chat, and then at the end, we'll look it up and go through all of those, and we'll address them at the end of the presentation. If by chance you have a more in-depth question or we didn't get to it, and you'd like to speak with us one-on-one, our contact information will also be available again at the end of the webinar. So feel free to get with us either through an email or you can call us and we can discuss your questions in further detail. I am going to turn the time over to Troy for the rest of the presentation.
Chelsea, I appreciate the introduction, and again, we welcome you as a group with us as well. One of the things Chelsea mentioned on the questions, and as we go, it may be just as easy for you. You can go ahead and submit your questions as we go throughout the webinar, but we won't address those questions until the tail end. And we have roughly about a 55-minute presentation, and with that presentation, we'll have the Q&A at the end, and we will stay on the Q&A for as long as we need to. For any of those who may be logged in that is having a hard time on the conversation with that as well, it did have both the PIN number to be logged in as well as the information there as well. Hang on just one second if you don't mind. It indicates that the audio is a little bit garbled. Let me just take just a second on that and make sure that we've got what we need. Let me know if that's a little bit better in particular for those who are having a hard time on the hearing, if you could. Okay, beautiful. So it looks like it's going good. Again, we welcome you to the Duty Drawback webinar. It's interesting what has happened with Drawback. We've been doing this for 35 years, but it's very interesting that the added interest with the Drawback has really hit a fever pitch with the new implementation of the 301 duties on the Chinese goods. For those of you who are familiar with it, recently U.S. Customs has also impacted some 301 duties that are going to be hit out of the UK as well. And we'll talk a little bit more about that as we're going. So with those added duties, companies are evaluating the circumstances and say, how can I be proactive? How can I deal with these duties? We're going to talk about that today. So today we're going to talk about what duty drawback is, who's going to qualify for drawback, what different types of drawback programs are available, and the required documentation with that as well. It's a 1-hour webinar. It's very, very truncated. We have many times we travel the country and provide 4+ hours of seminar in greater detail. So here you're going to get that truncated version. But we do want to welcome all those that attend. We've got companies all throughout the United States, Canada, Mexico, and we even have a few that are from China, which would be 3 a.m. in the morning. But again, we do welcome you here as well. With the Duty Drawback program, it's interesting because, as Chelsea mentioned, we are custom house brokers. That allows us the privileges of dealing as a broker, representing companies for imports, transportation, and all the goods. But uniquely, our business model is exclusively dealing with duty drawback and classification of the goods. We choose through our business model not to handle or be diverse in having import entries and solving those types of problems. Our focus is exclusive drawback and has been well before drawback become popular. That being the case, we're very good at what we do. We've been sitting on a drawback subcommittee for customs over the last 4+ years, made recommendations to Customs on those changes of the new TEFTA laws and rules and regulations, and continue to sit on that for the rule-making process on the tail end of it. Very, very familiar with Drawback and very adamant of working with Customs along the lines. This slide here shows the examples of different types of industries. Companies are interesting because they always say, well, who else in my industry have you dealt with? Many times we've dealt with companies on every given industry that is out there. And this just shows a few of those industries that are there. Bottom line, if goods are imported to the United States and subsequently exported either in the same condition or through a manufacturing process, or if they're destroyed in the United States, they're going to qualify for a drawback program. So regardless of the industry, regardless of the uniqueness, those are the real criteria of saying, how am I going to qualify, or do I qualify for a drawback based on my circumstances in particular as well. One more slide here just to kind of show you what we deal with. Left-hand side, our expertise is putting together duty drawback programs that has a refund process of gaining the customs duties, the fees, the HMF and the MPF, excuse me, the harbor's maintenance fees and the merchandise processing fees, and also the IR taxes, or the federal excise taxes on imported duty-paid goods. And there's a number of industries that are hit by the IR taxes, which include, they call it the sin taxes on tobacco and alcohol, but also guns and ammunition, bows and arrows, tires, fuels, and even on the medical industry. So there's a number of industries that are hit with the IR taxes. And if you're one of those industries and you're looking to gain drawback, not only the duties and the HMF and the MPF, IR taxes are also applicable. The related services we deal with, we've got a group that handles the classification. We educate on classification, but also help and understand, because we realize there's a number of companies that actually have multiple brokers bringing the exact same products in, and yet they misclassify them, or one is classifying a different rate than another as well. So our classification specialist has actually hit in and helped quite a bit in being proactive on correct and accurate classification of the goods. We also deal with Canada on both the drawback and then the GST, the goods and services tax, simply because a lot of our clients, in fact the majority of our clients, will also export to Canada and Mexico as well. Where applicable, we've got an outsourced group that reviews audits of transportation costs, contracts, and also the review process there. We only do that simply because, again, we get asked on a frequent basis what's going on. Our specific services rotate specifically around duty drawback and classification of the goods as well. Well, other services which we offer as a drawback group that others don't. Good examples of how we solve problems with that would be third-party participation. So if you're buying domestically imported duty-paid goods from someone else, have a duty-embedded cost of those goods that you subsequently export, we can roll them into your drawback program. If you're importing the goods and paying the duties and selling them domestically to another individual's export or record, you could roll them potentially into your duty drawback program. Also, acquiring proofs of exports. Those are the number one problematic concern that all companies struggle with, is having the appropriate proofs of export. So we're going to talk about what it takes to be an appropriate proof of export just versus a proof of export. A number of other things we do is we've got an audit team where necessary, where the manpower is shallow in the company, so we can actually send an audit team out to gather the appropriate documentation. We obviously maintain our records for customs, the statute of limitation time period, and become that middleman in between customs and our client. So you're here today specifically to deal with the 301 tariffs. And again, historically, it's only been on Chinese tariffs. Now, or Chinese products, now it's actually going to spread to the UK and many other countries as the United States goes through and tries to get fair and equitable taxation of these goods as well. We're going to talk specifically about the Chinese imports because that's really where the majority of the individuals have said they've got concerns. Obviously, we're at a point of saying there's $250 billion on an annual basis of goods that are imported that this new Chinese duties apply to. And in addition to that, if they're applied to all of the goods, it'll be in excess of $500 billion of goods that will have tariffs of at least 10%, if not 25% across the board. And so we take a look at this one, the drawback process. I want to talk about two aspects. One is the core drawback. Core drawback has been the drawback that we've been doing for many, many years. In fact, up until February of 2018, the old drawback services were just deemed as the drawback, but now they're deemed as core drawback. We talk about this because we still have a number of claims outstanding and a lot of our clients who are applicable with the core and versus the TEFTIA as compared to claims which we made there as well. So the new drawback laws kicked into effect on February of 2018. There was an option to either use core claims or TEFTIA claims. Now, as of February of 19, exclusively we have to file our drawback claims under the TEFTIA. So TEFTIA would be from February of 19 to current and onward. Core would have been February of 19 prior of the time period as well. So when we take a look about some of the specifics about the 301 duties, we want to get in and say, what were they? They were broken into 4 lists initially, which was only list 1 and 2, then it went to list 3, and then list 4, and now 4 has been split to A and B. 1 and 2 was implemented for the first $50 billion of imported duty-paid goods, and they came in strong and heavy at 25% duty. And that started as July 1st of 2018. In September, list 3 kicked in as September 1, and those tariffs were initially implemented at 10% duties, and in September of 2019, those duties were bumped from the 10% to the 25%. So list 1, 2, and 3 are all at 25% duty. List 4, forever, up until just the last few months, has been one of those things that have said these are going to come, but we don't know when and how. List 4, as it's finally implemented, got split into 2 groups, 4A and 4B. 4A that kicked in recently that said these are the items in which we're going to currently implement the duty, or excuse me, the associated duties, the 301 duties, and list 4B will implement in December of this given year. Now, it's still a little bit up in the air as to what the rate will be on 4B, but it will be that there's no question it's going to implement unless the deal is struck with China. The way things are going and all the problems that are out there, I personally can't see that deal being struck. I'm pretty confident that virtually all of the goods imported in from China that fit those classifications that do not gain an exclusion will be dutiable in the United States as well. So the application of these duties would be such where if my original duty on my imported good, regardless of what it was, originally was 3%, I was on list 1, 2, or 3 at the added Chinese duties, or a lot of people call them the Trump tariffs, of 25% to be applicable. The 25% does not supersede the old duty at 3%. It's in addition to. So my imported value of my goods will be now assessed at 28% of the total duty on those goods that are brought into the United States. That additional duty is in addition to the original duty that was there as well. And so that's a pretty big impact. I'll just kind of give you just 2 high-level case studies. One of our clients at the time, they wanted us to provide a duty drawback process for them. They were paying about $50,000 in duties and exporting just short of 50% of what's there. Well, it puts a pretty nominal drawback program together at $25,000, and so we told them to hold for a period of time, especially knowing that the new duties were going to be kicked in effect because the majority of the goods were brought in from China. When they implemented the new Chinese duties on list 1 and 2 is where their categories of the goods hit, they were then assessed an additional $1.3 million in addition to the $50,000 they originally had, and again, where they're exporting 50%, now this put them in a position where they can actually have a significant drawback program because those goods are subsequently exported. Second case study was one of our electronic clients. They were based out of California. They had 17 offices and manufacturing facilities across the country. They were paying about $1 million, $1.2 million a year in duties. They were also all on list 1 and 2. When those tariffs kicked in, they had to now pay an additional $12 million. And I can tell you this, regardless of the company you're in, but in this in particular, you've got upper management very concerned about the additional duties and whether or not they'd be able to pass those on to their customers or look strategically and gain some of those duties back using the drawback program that we already had in place for them as well. So it brings us down to what is duty drawback. Duty drawback is a refund of imported duty-paid goods that are subsequently either exported outside the United States or if they're destroyed within the United States as well. And that could be goods that are actually in the same condition or it can be goods if you're a manufacturer. They're then combined as raw products into a finished good, but then subsequently either destroyed or exported. So that poses the question, really, is who's going to qualify for drawback? Many of the financial institutions or portions of the companies are very concerned about what's the impact of drawback, and is it worth putting some time and effort into the drawback program? Now, these two slides are prior to the 301s because we don't know exactly the proportionate impact of the prior to the 301s, but prior to that, there was an estimated $2 billion a year of duty paid on imported goods that were subsequently exported outside the United States that qualified for drawback, and they were also going unclaimed. What was going claimed was only $1 billion of the $3 billion available, leaving $2 billion unclaimed, $1 billion that was being claimed. So roughly only 1/3 of the available drawback was being participated and drawn back through customs prior to the implementation of the new 301 duties. Well, I can tell you we've been absolutely inundated by many companies that had either a very low duty rate or perhaps no duties, and yet they were in that category of falling into saying, okay, now we're subject to the new 301 duties. Automobile industry is a good example across the board. We've picked up a number of clients because previously they were paying either duty-free or very, very low duties, but now they're getting into 25%, and again, they're reading and saying, how on earth can we do this, and what is the impact? When we talk about what is the impact here, on the far left-hand side, it shows on that spreadsheet, or on the graph, 7.11% return. What we did is we took the Fortune 500 top 50 companies and said, if we use that as a milestone, as a marker, how do we compare? So what we did is we took their total gross revenues, we backed off their cost of goods sold, or their COGS, to get the net operating income. From that, we reduced it by their administrative cost, we backed off their depreciation, and also their income tax liability, and the bottom line of the net income was that 7.11%. So depending on how you sit in your organization and what your bottom line is after tax, after depreciation, would fluctuate compared to what you see on the screen. This gives you a good solid basis of the average of the Fortune 500 companies. So to the left of the screen, you'll have from 0 up to $30 million in sales. On the right, we'll show you various points of drawback returns that are there and what they would have to do. So if you took a look at $250,000 refundable in drawback, and most of our clients are within that $250,000 to multiple $1 million of refunds that are available. But this company, if I had $250,000 in refunded drawback, what would they have to generate in sales to put the same $250,000 to the bottom line? Well, if you look above it, it would show they would have to generate $3.5 million in additional sales to drop that $250,000 to the bottom line of refund of drawback. So you can look that exponentially for every dollar that's drawn back in a refund, they would have to generate 14 times that in sales in order to put the same dollar amount to the bottom line. If I have $1 million in drawback refund, I would have to generate 14 additional $1 million in sales. But this is where the financial end and perspective of companies take a look at and say, wait a minute. If I can drop some dollars to my bottom line, and it's equivalent to having 14 times that in additional sales, and it doesn't cost me another dime to get it, this is what makes sense. Statute of limitations allows me to go back up to 5 years. Well, if this is only correlated with the 301 duties, it's only going to take you back to July of 2018, and then on, depending on if you're in list 1, 2, 3, or 4. But bottom line, this is the impact of what drawback can do. Now, many of our clients we've had for drawback for an extended period of time, and they just then get augmented by the new additional 301 duties as to what's going on. So truly, a company needs to take a look at not only what they're paying in duties currently, if they're impacted by either the Chinese duties and or now the new EU duties, but also what they've been paying duties in a prior time period. But at least bottom line, this is what the financial group looks at of saying, we need to give serious consideration to a drawback program. Are we going to qualify for drawback? How do we qualify? Who qualifies for drawback? And that literally leads us into the next question. It's overlooked on many occasions, but bottom line is, who is going to qualify for drawback? Well, there's a pecking order on who qualifies for drawback, and you don't understand that. If I am the exporter of record, I really have first right of refusal to claim drawback. And if I'm the exporter of record, I should have both import documents and the export documents if I am the importer of record. What mandatory required documents are from customs on both the import and the export side? Well, they're here left on the screen. Commercial import invoice, packing slip. Now, I got to be aware, packing slip on both the import and export is not a mandatory requirement from customs, but for the 35 years we've been doing the drawback, we know that the majority of the time the packing list will have all of the level of detail necessary, and many times the commercial invoice does not, especially when you get to wearable apparel. Wearable apparel is mandatory. You have size, style, and color, and there's never enough room on an invoice, or rarely enough room on an invoice, to have size, style, and color in there with all of the other items. So in our perspective of gathering documentation, because we want to gather all of the docs, we're saying commercial invoice and packing slip on the import entry side is sufficient and is mandatory, as well as the entry summary that'll give us line item detail of the HTS-US and the duties that are paid. On the export side, what is required? Commercial export invoice, mandatory by customs, packing list, which is not, but mandatory by our group, if we're going to handle it, and 3 would be that proof of exportation. We'll talk more about the proof of exportation as we go and some of the nuances of the proof of exportation, but if I have this level of documentation and I put a privileges application in the customs and they've accepted it, I can then generate a drawback program going both retroactively and prospectively as well. What if I'm an exporter record, but I buy domestically imported duty-paid goods by my suppliers? And many of our clients have exactly this circumstance. 35 years ago, we noticed there was a disconnect between importers of records and exporter of records if you have two separate parties. Why would an importer record not provide that documentation willingly to an exporter record? If you stop and think about it, very sensitive information. The source of where it came from and also the cost would be identified in those invoices and those entry summaries. The importer record would absolutely lose the negotiation piece for their customer if the customer knew how much they actually paid for the goods. So they will not provide that documentation to the exporter record, and understandably will not. So when we put a drawback program together, we actually stand in as a broker. We represent, in this case, the exporter record. They introduce us to the importer record. We have a very solid 5-page non-disclosure agreement that goes to the importer record stating, under no circumstances would we ever divulge our import documents that they provide to us, to our client and the customer that we're actually going to claim the drawback for. That being the case, they have their legal teams review that and ensure that they're solid, and that being the case, they then provide us the import documentation that we never divulge to our client, but we marry those import documents with the goods that have been sold to our customer and client with our client's export documentation, and that way we have sufficient documentation for our client as the exporter record to file a drawback claim. Granted, it's also contingent upon priorly having authority from customs through the privileges application and acceptance of that we can actually file the drawback claim. The exporter record would qualify for drawback. The real question is anybody else who qualifies for drawback, and the answer is yes. Now the screen here will just show you those records. From our client, the exporter record, we get the commercial export invoice, the packing list, proof of exportation. Through that power of attorney, it allows us then to go with a non-disclosure agreement to the exporter record, or the importer of record, and gain the commercial import invoice, packing slip, entry summary, and also today put together what's called the certificate of delivery, or showing that the goods were imported by another party and they were sold to the exporter record, and drawback is understood that those rights go along with those goods that have been imported and then subsequently exported outside the United States. So those types of documents are required no matter who is filing for drawback. And so follow with me on the next couple of individuals that qualify for drawback. The next company that qualify for drawback would be the importer of record contingent. Contingent upon what? Contingent upon getting the exporter of record documentation, proof of export, and an assignment letter assigning the drawback rights through a letter of endorsement. They're going to endorse those drawback rights back to our client, the importer of record. Then the importer record can qualify for drawback. They are in a second position, and if they do not gain the cooperation with the exporter of record and the documentation and having that letter of endorsement, the importer of record cannot claim drawback. Now you stop and think about that. If I'm the importer record and I'm selling to a company domestically and they are exporting, How do I know that my client, my customer, the exporter record, is not claiming drawback? It's pretty simple. The required documentation would say the exporter record has to have the import documents, and they can get them in no other way. They would have to go to the importer record and petition those documents. And again, it better be through an independent third party that will not divulge that information to them, but that is how the importer record can know drawback is going unclaimed. Well, a unique situation where there's a third party that qualifies for drawback, and that would be an intermediate consignee. Company A imports the goods in the United States, pays the duties, sells them domestically to Company B, the intermediate consignee. Company B sells them domestically to Company C, and Company C exports those records outside and those goods outside the United States. Intermediate consignee again can know the drawback is not being claimed if his customer, the exporter record, does not come to him and say, we want to participate in the drawback program, we need your import docs. And if the importer record has not come to him and said, we're needing and requiring these information and these documents as well, you can know that drawback goes unclaimed. So one of the largest disconnect in the potential for drawback, and prior to the 301s, there was $2 billion a year going unclaimed, is that disconnect between third parties, sort of an importer and exporter being separate, let alone if an intermediate consignee is in the middle of that mix. Intermediate consignee is one of the most difficult drawback programs to put together. Why? It's a simple program, but you now have three entities that are required to have documentation that is compliant with the drawback program, and sometimes it's difficult enough to get one on board and in compliance, let alone having two additional parties, they need to be in compliance as well. And if anywhere along the line, one of those parties says, no, we're not going to provide these documents anymore, then that drawback program is dead in the water. Now, another scenario that happens quite frequently. If your import broker places himself as the importer of record, or you're shipping to a consolidator, and that consolidator places himself as the exporter record, the question is this: can either that broker or that consolidator claim drawback on your goods? And the answer is no. Why? Drawback is driven by title and ownership. Though they had physical possession to move and transport your goods, possession is not one of the requirements for drawback. Title and ownership are the drivers. So there's only three parties who can qualify for drawback here, and that would be the exporter record, the importer record, or an intermediate consignee. You cannot have a broker nor a forwarder claiming drawback for themselves on any of the product they move. They could do it for a customer, but they could not do it for themselves. So those are the three entities that qualify. And if you're any one of those entities, you need to give serious consideration to completing that one-page questionnaire and getting it to us for a confidential review, because though you may not be both the importer and the exporter record, drawback could still apply if the other party's not coming back to you. Now, some of the changes, some of the TEFTIA changes as compared to core what it was. First change on that would be the transfer from an importer record, Company A, to a Company B, and B is the exporter record. It used to be required to have a certificate of delivery as mandatory part of that equation. Now Customs says, well, the CD is no longer required. But what is required, import docs, invoice, packing slip, entry summary, and a statement from the importer record stating that one, they haven't claimed drawback, and two, they won't claim drawback in the future as well. So in essence, you still have to put all the documentation together as a CD. From our standpoint, we pretty much just put together a CD when there's disjointed parties like that, because it then has and maintains all of the documentation necessary to pass those goods on to a client using the TEFTIA drawback. One of the other TEFTIA rules, and we actually fought Customs quite heavy on this, Customs went ahead with it anyway, that says both an importer and an exporter are held jointly and severally liable for drawback of any drawback that has been claimed in error that needs to be refunded. So let's go back to the scenario. Company B, the exporter of record, goes to Company A, says we want to participate in a drawback program. A supplies through an NDA to the broker those drawback documents. The imports are then correlated with the export, and that export is claimed. But for some reason, we have bad information in there, and that $50,000 claim should be actually refunded to customs and not valid. Now, we've never run into this situation, but here's the scenario they're painting. If customs comes back to our client, the exporter record, and says we have 50 grand that we need to have refunded because we believe you don't qualify for drawback, and our client drags their feet and they ho-hum and they don't do anything, customs finally says, you know what, now we're going to hold both you and the importer record liable. That is a real possibility. Now, if I'm the importer record and I want to cooperate with my customer to allow them to claim drawback, I probably have at least two options, and we believe good solutions. One is have an agreement, an absolute agreement with my customer, the exporter record, that in the event they make a drawback claim that is either an error or challenged by customs in any form, and customs comes after me for that amount of the refund, then my client will make me immediately whole and good and valid within a very short time period. I'm made whole regardless. Second option would be for the importer record to say, I will grant you these rights of drawback through this certificate of delivery process, provide the documents to your broker to file the claim, but if there's an error on the claim, one way we protect ourselves is to say that you put a privileges application. We're only going to support this program if you have a privileges application on the customs. If in that privileges application you have accelerated drawback privileges, you have to petition for those privileges. And third would be for every drawback claim you generate, you have to have an accelerated drawback bond. Now, what does that bond do for you as the importer of record? It protects you. How? Go back to the same scenario we just talked about. Customs says, I've got a dispute with you, exporter of record, on this $50,000 claim. I want the money back. The customer actually drags his feet, won't pay it back to customs. Customs give them whatever time frame is reasonable. Then what they do is they immediately turn to the surety company and say, I've got a claim here for $50,000. Surety company, you owe me 50 grand. Customs is made whole. They now don't pursue the importer of record or the exporter record. They've gone and they've been made whole from the surety company. Now the surety company has an issue with the exporter record. They claim it there was an error, but the importer of record is out of that loop. So we really believe there's two ways to protect yourself. One, to have an agreement, a written agreement signed by both parties that says, if customs comes after you for an error on a drawback claim, we will make you whole. Or two, if we put this drawback program together, the only way we're going to actually use your imports of record is if we have a privileges application, accelerated privileges submitted, and accelerated drawback claim with every given claim that protects the importer of record from customs coming to knock on the door and saying, you owe us money. What type of drawback programs are out there as well? Well, let's walk through those real quickly. There's a number of different types of drawback programs, and you have to make sure that your privileges application is reflective of what you're actually doing. If I'm bringing finished product into the United States, and I'm not further manufacturing it in any form, and I re-export those goods outside the United States, that's called an unused drawback program. In an unused, I can do certain things to these unused products coming in, like test, clean, sort, refurbish, repair, or even replace components, and it doesn't cross that line for manufacturing or production. So as long as whatever I'm doing my good, repackaging those goods, taking bulk goods and putting in single units or units of 10 together, whatever the case may be, as long as I'm not manufacturing or any type of production, I can have those goods imported and exported under and utilizing an unused drawback claim. You need to understand it's very, very critical, because if I'm going manufacturing and I have both unused and manufacturing, I cannot claim manufacturer drawback under unused merchandise. Neither can I claim unused merchandise under manufacturing drawback. So I have to make sure I have separate types of drawback claims and privileges in the application of the customs prior to actually implementing those claims that are there as well. We'll also have goods that can be rejected merchandise coming to the United States. Maybe it's shipped without consent, or when it hit here, it's either defective or doesn't fit and crawl up to this, that does not actually stand up to the qualifications of the specifications that it should be. So therefore, I can turn around and re-export these goods, and I can claim it under rejected merchandise. And there are times you want to use the rejected merchandise. Now, under the core drawback, when we have rejected merchandise, we would most of the time default to an unused merchandise. Why? Because rejected merchandise is still unused in the United States. and you've got an option of either unused or rejected. If I claim it under rejected, there were some IR taxes that I could get back that I couldn't under the unused, but with rejected, I couldn't claim the HMF and the MPF as well, which is only 1/2 of 1%, or a little bit less than that as well. But in many of our claims, the IR taxes, the HMF and the MPF taxes can be multiple, tens of thousands of dollars, and so you want to make sure you include that. So we would default most of the time to using unused merchandise, but you've got a choice to either use rejected or unused merchandise when you're actually making those claims. Today, with the new TEFTIA rules and regulations, I can claim under rejected merchandise as well as destroyed merchandise both the duties as well as the HMF and the MPF, which previously I could not. And so, but we've got an opportunity. There's a couple more hoops you got to jump with rejected merchandise. I've got to get my manufacturer to also put a written statement together to say these goods were bad order goods when they actually hit the United States, and as they entered the United States, they didn't fit to the specs. And sometimes that's a lot more difficult than it sounds to get that manufacturer to make that statement and have that liability with it as well. Destroyed merchandise is also another situation where if I do not have a full-blown drawback program, I've got to apply to customs using that 7553 form. Same thing is true with rejected merchandise. If I do not have a full-blown drawback privilege application submitted to customs and approved, I've got to notify customs prior to each one of the exports, each one of the rejected exports, or each one of the destruction of the goods that are there. Making the assumption that it's a full-blown drawback program that's already in place, privileges applications have been remitted and accepted, we then can go through a process of destroying goods in the United States that have been imported and duty-paid goods, as long as we have a third-party verification or witness that those goods have been destroyed. Now, with 7553, if I don't have a drawback program, I can approach customs prior to the destruction of the goods or prior to the exportation of rejected merchandise and give customs an opportunity to either inspect the goods or waive their inspection. If they choose to waive their inspection, I still need to walk through the process and have an independent third party on destruction that says, you know what, I attest these items have been destroyed. If customs wants to witness it on either one of those cases, you can use customs attestation that they've been destroyed or exported, and that is sufficient to file a drawback claim under either unused, rejected, or destroyed merchandise as well. Well, as we walk through that process, we take a look and saying, what needs to be in that privileges application to customs? Customs now actually has a form that's actually pretty good that you can actually go in and pull offline, and it's a fill in the blank form. They didn't used to have these forms, and so we have to go through, depending on what privilege application we're going to apply for, and identify what type of privileges we're looking for. But to know that every given drawback privilege application ought to include at least the following, if not significantly greater, privileges you're requesting. One, for past exports, the statute of limitations on the look-back period is now a 5-year window from the date of import to the date of filing a claim, which implies it's been exported as well. But since you have not given customs an opportunity to inspect the goods prior to the exportation of the goods, you need to request from customs a one-time waiver looking backwards over that time period to say, we didn't give you a chance to inspect, we want to claim drawback, please give us that one-time waiver of all of the exports we've had in the last 5 years. Currently, and at the same time, we want to make sure we have a WPN or a waiver prior notice. We want customs to waive their inspection request on a go-forward basis. For every given export we have that we're going to claim drawback on, we don't want to have the hassle of customs of saying we have to notify you, give you a chance to inspect those goods prior to the exportation of the goods. But it's all based on this privilege application we're putting together. How detailed, how good, how solid that information is, and what we're requesting from customs is whether they're going to make the judgment call on that company to say, we're going to allow you a one-time waiver retro, or we're going to allow you a privilege application on the future of you don't have to worry about the inspection, which is nice. For more rapid refunds of the request, we also put together always the privilege application to be accelerated drawback as well. So that means that every given claim we submit, customs will process those claims. Historically, under core, it would take them 2 to 3 months. Under the new TEFTIA, it's taken a lot less time period than that. And for ongoing clients that we've got, we'll see refunds within just a couple of weeks, 2 to 3 weeks after that as well. But if you bank on 2 to 3 months using accelerated privileges, that is a good solid time period, because the accelerated privileges means as soon as they process it through, they will refund those bases on you, the refund of the claims that are made, and it's always subject to that audit. Now, if I'm going to use the principal substitution, I got to make sure that I'm compliant with the substitution laws. If my accounting process is other than what the company is doing on their normal accounting basis, we have to identify the customers. We're going to actually use a different accounting method and receive approval from that as well. We put that information into customs, and we indicate to them also what type of tracking methodology we're going to use. There's only 2 methodologies. One is a direct identification. So with direct ID, we can actually use a specific serial number, a unique non-repeating identifier. One of our clients will put in a unique identifier on rolls of material that come to the United States. It's used in various capacities. It's put on in the factory. It's actually tracked through the import process, the inventory process, and through export, so we can use that unique identifier. And many times we don't have a unique identifier or serial number. Our clients will actually use either a SKU, perhaps a lot number, or something that specifically identifies the product type. But then we have to drop down and say, if we have that methodology, we use some type of accounting methodology of LIFO, last in, first out, FIFO, first in, first out, a low to high methodology, and average price new, or another methodology as well. Those are specific issues we need to address to custom of what we're going to use in this circumstance and how we're going to track the goods. Direct identification can be used on Drawback on anywhere around the world. The principal substitution is really the majority of what the new TAFTA laws and regulations have altered or modified. Ironically, Customs calls it the simplified drawback. Well, this new simplified drawback program using the TAFTA is anything other than simplified. It's more complicated now than it ever has been. They anticipated it's going to be easier because they're saying, instead of us making a judgment call on every given industry of the goods you're bringing in as compared to the goods that are exported, we have to make a judgment call previously. Is it commercially interchangeable? Is it fungible in all situations? And they had to make that judgment call. And I understand that was complicated for Customs because of the myriad of different products that are there. They've now defaulted to using the HTS-US on either an 8-digit level or a 10-digit level to actually track the goods. So now the new TAFTA law says, if my import goods have an HTS for the first 8 digits of HTS match on the import side and the export side, I can claim drawback and use the principal substitution contingent. Contingent on what? Is that the 8-digit level, that the explanation in that category is a specific explanation under the HTS rules and regulations. But if it is an other category, you cannot use the 8-digit. You're forced then to go to the 10 digits. So all 10 digits on the import side have got to match 10 digits on the export side, and many times on using the B3 number, especially historically, they've defaulted to a number that rarely match the import goods, so they've got to watch that a lot more closely. But again, on the 10-digit level, if the heading is a specific heading, women's clothing, whatever the case may be, then we can use the tracking of the substitution methodology if it's there. If it is an other category, and there's a tremendous amount of other categories, we cannot use the principal substitution because on the 8 and the 10-digit level it's other. We then have to default to direct ID. The other limitations on substitution is substitution cannot be used on project on a drawback program that has goods shipped to a NAFTA country, either Canada or Mexico. Principal substitution cannot be applied. So if I want to use principal substitution, I can match both the 8 and or the 10-digit level on all my products, which is fine. But if I had goods shipped to Canada and Mexico, I'd have to use substitution on everywhere else around the world and only direct ID on Canada and Mexico. So then you need to evaluate your whole process and say, do I really truly want to run 2 different forms of tracking, substitution and direct ID? Because the new simplified drawback program says on a line item level, my invoice, if I have used the principal substitution on a line item, I can never use that as a direct ID item. So I might have run in 1,000 units and only claim drawback on 200 units that went export using the principal substitution. I've got another 400 units that I'd use under direct ID to a NAFTA country. I can no longer use that line item that I use it on substitution to claim against under direct ID. I have to go to another line item, the exact same product, and then start deducting that way. And my accounting has got to track by line item on the imported goods and whether or not I've used either substitution or direct ID. So it throws a huge monkey wrench in the accountability of what's going on. And also on companies that are saying, how do I want to track it? Do I want to track a direct ID or the principal substitution? Either can be good, but know that there are caveats with those different methodologies. Well, we put together a privilege application. We've already gone on the import docs and the export docs. Additional documentation may be any type of standards, industry standards, any types of samples of a part number and a description, catalogs that are there, explanation of the processes or what you're doing. Especially when it comes to the manufacturing, you've got to go to great lengths of saying, this is how we do it. We provide a bill of materials or a BOM with our products, and we're tracking all of the imported goods through a bill of materials to a finished product or a semi-finished product, and the semi-finished product to a manufactured product or semi-finished product to an export as well. So there's lots of processes that are in there. You need to explain this information to customs and the process. Our typical privilege application to customs historically is about an inch to an inch and a half thick when we actually have to submit them on a hard copy. Now we can submit them electronically. It's still not through the ACE program we can submit them electronically. We can submit them electronically to customs regardless. Customs typically takes, historically I'm talking, under the core drawback program, we would be 3 to 4 months on the privilege application to be approved. Customs is way behind, and they've added easy 2 to 3 more months on the processing time. In fact, all of the 4 drawback offices have received guidance from headquarters to say, put as a priority manufacturers in processing the privileges applications prior to the unused merchandise, which I don't understand their thought process and mentality, but that's what they've given them priority, so it's now putting an extended period of time getting that the privileges application approval process. But usually within 7 to 9 months, we've got the privileges application approved, and also since we've submitted claims in the meantime, we've got drawback cash that starts coming back to our client during that same time period as well. Let's shift, if we could, to the manufacturing process. Manufacturing, you would anticipate it's pretty straightforward. So really it's a process where I have anything that I produce, either with single item or multiple products, that has a distinctive name, character, and use. I bring in raw, clear resin beads. I also bring in a blue dye. I run that through an extruded blow mold machine, and I extrude out a water bottle. I've got one sitting on my desk right in front of me. It's got a blue tint to it. There's no question it's got a unique name, character, and specific use, so that's going to be manufacturing, hands down, no question. The real question in the process would say, what if I'm assembling goods? Does the assembly cross the line into manufacturing? So if I assemble some components, I've got a clutch plate, and I've got a throw-out clutch, and I bolt them together with 4 bolts. And when I put it in the box, it is specifically for a Mazda 3 2013 through 2017. Now it's meant for a specific use. That actual assembly now crosses that line and says it's actually manufacturing. So you've got to know in your assembly process, each one of those components, is it manufacturing or is it unused? Because there are times when it's not manufacturing and it's actually unused, but you've got to be able to differentiate between those two as well. We track to the manufacturing process usually utilizing a bill of materials. A bill of materials, for those who are not familiar with it, says what components go into my goods. So top left-hand corner says I've got a valve and a case and a gauge that go into manufacturing a pump. $9.17 and $12 respectively are the values. The 3% duties prior to the new Chinese duties kicking in at 25% are displayed. It becomes that part number in the middle, HL34WD, and then the top right, the total amount of duties was $1.14. Well, $1.14 per pump is not a whole lot of money to chase on drawback, and companies now would look at that prior to the 301s and say, that's marginal. But now let's look at the bottom left. New costs on the exact same goods. We've got the valve, the case, and the gauge, same cost, but now we have the additional 25% Chinese duties in addition to the duty, the 3% that is there. It generates the exact same part, pump in the middle, HL34WD, but now the duty value per part is $10.64, 10 times the value prior to the 301 duties kicking in. If I'm exporting 100,000 units or 1 million of these units, you can see exponentially that, hey, this process needs to be evaluated and give serious consideration for what I'm doing, or if I'm a broker and forwarder, for my clients are doing, because this puts bottom line dollars to the client and customers there as well. Well, a few more items we want to talk about. One is the statute of limitations time period. And it used to be, under the core, that I would have from the date of import to the date of export, I've got a 3-year window. So I have 3 years to export those goods that came in, duty paid. And from the date of export to the date of filing a claim, I had 3 additional years. So technically, I had a 6-year window from import to filing a claim, as long as the goods were imported, exported, and within that window of opportunity. If I'm manufacturing, it was a 5-year window from import to export, and then 3-year window from export to filing a claim, which gave me up to 8 years that is there. Now you stop and think how you import. You don't import goods, throw them in a warehouse and let them sit 2 or 3 or 4 years prior to exporting and then selling those goods and moving on. But the statute of limitations allowed literally for an 8-year window if I'm manufacturing. The new TEFTIA laws and rules and regulations will say, from the date of import to the date of filing a claim, which implies that I've imported the goods, subsequently exported them, and also now filing a claim, is a 5-year window from import to date of filing the claim. And that's for all. Unused, that's the rejected, that's destroyed merchandise, that's manufactured goods, all the same statute of limitation time periods that apply to all across the board. Less confusing for companies, also less confusing for customs as well. Well, if we take a look at it, how long do I have to retain these records? Statute of limitations on the new TEFTIA laws, it ended up being the same as on the TEFTIA as the core, which is 3 years after the anniversary date as a liquidation. But stop and think about some of these goods. I have a 5-year look back that I can go back and draw imports and exports from that I can then file a drawback claim. So let's make that assumption, and we do this frequently. We file a drawback claim on November 15th of 2019, and I can look back on imports and exports up to 5 years ago. So I file a claim today based on the last 5 years history, and I've got those documents in that 5 years. Customs usually takes about 1 year to liquidate the claims, and then I've got to maintain those records for additional 3 years. But if I file the claim and I look retroactively, I've got to have records for 5 years, the 1-year window of actually liquidation, and the additional 3-year window of having to maintain those records. I have a 9-year span of records I need to maintain if I've looked back the full 5-year statute of limitation time period. That is 2 years longer than required on the IRS requirements of the requirements for corporations to maintain records. So you stop and think about this. I file a drawback claim today that goes retroactive to 5 years. I've got to maintain those records for up to an additional 4 years, but I've got a 9-year window I've got to hold. Strong suggestion, if you get nothing else out of this drawback, is for any drawback claim you generate, you retain 100% of those records with yours independent of what your company holds and maintains. Because when customs comes knocking, you then have the records and the documentation you need to draw back on for those records to say, here's the import documents, here's proof of export on the export side, we've got everything we need. If I do not maintain separate records from what the corporate records are, at year 7, many of those corporations will purge the old records and wouldn't even have available on a hard copy records that are there. Same thing is true on documentation electronically. Many times it will purge those records or throw it into an added off-site storage to maintain those records. Hard to get to. So again, any drawback claim you generate, have and maintain all of those records, either electronic or physically, going back to the time period you have, and maintaining them for the statute of limitation time period, which is 3 years after the date of liquidation. Now, many liquidations are stretched an additional year or 2 years. That could put this time period of having these records up to 10 and possibly 11 years of maintaining those records if you can use that full statute of limitation time period. A real caution to look at as a whole. Well, we want to talk about NAFTA drawback. NAFTA drawback would say imported duty-paid goods that go through a manufacturing drawback and then sold to either Canada or Mexico, very little duties available from manufacturing United States, and that's unfair. If I pay $10 on those duties of goods coming in the United States, further manufacture a good that ends up being $50 that I sell to Canada, and Canada's got zero duty going into Canada, and Mexico has 1% of that value, it's a lesser of the two rule. So I can get max back 99% of either my $10 of the imports into Canada, or excuse me, in the United States, as compared to no duties going into Canada. The lesser of those two is going to be zero, so there's no drawback available. On the same product that I paid $10 of a unit coming in, I sell it to Mexico at $50, and they've got a 1% duty going into Mexico. There are only 50 cents duties available for drawback for refund, because that's a lesser of the $10 on the duty paid on the import into the U.S. as compared to the import into Mexico. Most of our clients that are manufacturers that then turn around and sell to a NAFTA country, Canada or Mexico, there's very rarely any drawback available because of the lesser two program. When NAFTA was put into place 27 years ago, the whole intent was to drive those duties down between the three countries to a very low duty or no duty, and that's been effective that way. The real problem is, for manufacturing in the United States, you take in the shorts. You cannot claim drawback on those goods simply because the lesser of the two doesn't allow you any warrant to do so. Now, I say that with manufacturing, and it's unfair. We strongly, I get up on my soapbox, say, get with your representatives, get with your senators, tell them they need to change this. When the NAFTA program was going to be reviewed by President Trump, we talked about, I was pretty excited. All they had to do was eliminate the lesser of the two in that verbiage, and we get full drawback, just like we do anywhere else around the world for manufacturers. That would be fair. That would be equitable. They didn't. They omitted that piece, and it remained in that process. But is all lost? No. If I bring in finished products in the United States, and I spend that same $10, and I then export it to Canada and Mexico as finished goods, or what they call in NAFTA, unused goods, I can then claim full drawback on those items. I can also claim full drawback if goods originated in Canada or Mexico, came to the United States, and then terminated in Canada or Mexico. But again, you got to remember, it's a nominal duty that is paid on those goods that originated from Canada or Mexico, came to the U.S., and then subsequently exported to Canada or Mexico. The last piece I really want to hit here is the proof of exportation. Proof of exportation has to prove 5 things. And this is the number one concern and the number one problem that most drawback companies and most companies that are claiming drawback have. That proof of export has to not only identify what the goods are, but establish fully that the goods were exported on a specific date and they were exported all together, and who the exporter of record is. The key component is tying in the international proof of export with my commercial invoice and or packing slip. How can I solve that? I can put my invoice number, my PO number, maybe a container number or SIL number on the actual international BL. I can place the BL number on my invoice to correlate those two. The whole intent, as customers will look at, just because you have a physical document or electronic document that you have an international proof of export doesn't say that it's a valid proof of export. More often than not, they'll have a date at the bottom, but it won't say laden on board date. Neither will it say the date it actually sold. So I may have my proof of export, but it's not a valid and complete proof of export as well, because I don't have all of those 5 correlating tie-ins as well. Well, with Drawback, it's a wonderful program, a program that we believe is that silver lining. Even if you go to use an FTZ and you paid duties to customs, the only way you can get it back is through a drawback program. So if by chance, by a long shot, that your product is good, valid for an FTZ, wonderful. Most companies can't afford it because it's very expensive. Most companies have such a hassle because they got so much domestic product that they have to pay those duties, and especially the Chinese duties, they've got to pay the full Chinese duties. They can't alter and deal with it in the manufacturing process like you used to and pay only the duty based on the finished product. They've still got to pay the full Chinese duties. Drawback is a wonderful program and an opportunity here to have full drawback through companies like ours that can help and assist you in putting it together. Bottom line is, we strongly suggest putting together a questionnaire, that one-page questionnaire, filling that questionnaire out, and making sure that through that process we can make recommendations for you to say, how can we go through and maximize your drawback program and what's available for you? And that's what the questionnaire there looks like as well. Well, again, we very much appreciate participating in the drawback program. We took a little bit longer than we anticipated, and I apologize about that. But what we will do is we'll roll now into the questions that are there. So if you've got questions additional to what's going on, please let us know. But outside of that, we'll go to the questions that are here. So let me go down and get there to the questions real quickly, and we'll start addressing them. All right, first couple were the audio. And all right, one of the questions says, how often are the importer and the exporter the same entity? We've been doing this for 35 years, and we see frequently that companies are both the importer and the exporter of record. But we probably see, realistically, I'd imagine upwards of 70% plus of our clients that are either buying domestically imported duty-paid goods from a second party or selling domestic goods that are subsequently exported by another party, and that is where that cooperation goes. Previously, if you remember, I was talking there was $2 billion a year prior to the 301s that kicked in, or 2/3 of the available drawback that were going unclaimed. My personal opinion is the number one supplier to that, outside of just not knowing to understand whether they qualify for drawback, is because you have a separate party that's importer than the exporter of record. That, I believe, is the number one problem. So the majority of the time, we don't see where the importer of record is both the, where the claimant is both the importer and the exporter of record, and we've got to gain cooperation with another party. We see that far more often than we do a full-blown drawback program of being both the importer and the exporter of record. Though we do have a number of clients that are the importer or exporter of record, more often than not, we see that that would not be the case. Can the AES ITN number be used as a valid reference on an export document? Customs is unique. In the new TEFTA laws, rules, and regulation, they talked about 2 or 3 additional customs required documents that somewhere down the road they're going to be allowed to use as proof of export. As it currently stands, the AES is not as sufficient proof. What they're looking for is, what they'd like to see is the international BL, the airway bill, a freightway bill, or if you use an express carrier, not only the tracking number, but also mandatory having the POD or proof of delivery on that tracking number. Now, they will take additional supporting documentation, circumstantial. Sometimes you'll have a domestic BL to get to a consolidator that shows who the consolidator was, and it's got all of the detail, and the international BL will then refer back to that, the domestic BL, and sometimes we can use that bridge document as well. But to answer your question right here, the AES is not sufficient to show proof of export on that as well. The other question that really kicks into effect would say, if I've used a consolidator, who is listed as the exporter record? And if you, as the client, is going to claim it, or your customer is not listed as the exporter record, we then have to get a letter of endorsement from that consolidator back to the company that's actually going to be filing the drawback claims as well. All right, let's see. We've got additional questions we've got. Sorry, let me get here real quick. We are always asked and frequently asked, can they get a copy of what is available on the drawback? Our legal group, and it's sad to say how it is nowadays, has recommended strongly that we don't provide that out. Though we've got the questionnaires, we've also got recorded, not only this webinar, but other webinars. You're welcome to get with us and say, can we view one of the recorded webinars? We also have paid webinars on our website that are far more in detail, because we've got the 2 to 4 hours on drawback. We've got classification issues. We've got the Chinese duties. We've got a lot of other webinars that are paid that you're welcome to look at. But if you've got questions, plan on coming to us as well. Next question we had, are there limitations on the new EU 301s? And so what the limitations that normally are talked about would be when the 232s, the very first additional duty kicked in with this new presidential group, the 232s were the new duties on the steel and the aluminum, which was 25% and 10% respectively. When the 232s were implemented, it was very clear from Customs that they were not going to be allowed drawback. We disagree with that position the Customs taking. Then Customs implemented the new 301 duties, specifically on the Chinese duties or Chinese products. But the Chinese duties on the 301s are applicable for drawback. And since these new EU duties and whatever else falls in the future, if they roll under the 301 duties, they too will be applicable for drawback. And so, yes, we anticipate that drawback will be applied to the EU duties that are just now being put in place. In fact, this morning we had a conference call with a company that is in the auto industry, and they're bringing goods in from Europe that were subject to the taxes, the new EU duties that started October 2nd, which is just a few days ago. They want to know if they can participate in a drawback program. We're walking through that process of evaluation, determine what's needed, put together a privilege application, and subsequently we'll have those drawback claims. So yes, we're very confident that they'll apply for drawback and that we'll be successful in getting so. Next question. We've got, help me to determine what my drawback opportunities and refunds amounts are going to be. Okay, so they want to know how we're going to determine if in fact it's worth that amount of money and what that amount of money is. On our privileges application, or excuse me, on the questionnaire we provided to you, if you look what's up on the screen now, bottom left is up about 2 or 3. It'll say last full year of duties paid for the last 3 years. What we're requesting is saying identify and specifically identify duties only, not transportation, not broker fees or anything else, the duties only that are paid during that time period. Then on a high level, we need to have you know, which is the next question down, what percentage of the overall duties of the imported duty paid goods or subsequently exported. Now, one thing you've got to consider is anything you have factory direct would not come to the United States, would not be assessed the duties, and yet you still may have on the international sales. So it'd be nice to weed those items out prior to give us that percentage. But let's say, for example, we're paying $1.5 million in duties. We have 30% of the goods that are being exported. That would imply in a 1-year time period, you've got roughly $500,000 of refundable duties on that calculation. That's one of the reasons it's so imperative to go through and fill out and complete that questionnaire as well to allow us then to not only determine what's going on, but what we can do on available drawback for you as well. I'll give it a minute or two because I don't see any additional questions, but you've got our contact information there, both the number and you've got the email addresses. You're welcome to get with us. If you've got confidential questions, you don't want to be exposed to the group of your specifics, to get with us. Bottom line for us, you who got duties paid on imported goods that are subsequently exported or destroyed qualify for drawback, you need to say, I can legitimately pursue those refunds and I know what's available. Or you could legitimately say, I know the amount of duties I'm paying and I choose not to pursue it. But lack of knowledge should never preclude you, nor the complications of the drawback program, because we've taken a very complex process of duty drawback and we recommend highly you outsource to our group. We're very good at what we do. We were experts in the field. We've been doing this for an extended period of time before drawback was popular with the new 301 duties. We know how to implement a drawback program. Probably 20, maybe 25% of all of our clients come to us that have tried a drawback program through another broker that have failed, either significantly underscored what there's available there or didn't ever get any drawback refunds or never got the privilege application approved by customs, and yet we've been able to take those programs on, successfully implement the drawback programs, and successfully get drawback monies for our clients. I don't see any additional questions, so again, we very much appreciate your participation. Any subsequent questions you have, feel free to contact us. Thank you very much.